Hi, my name is Greg Whicker with BGBC, and today we are going to talk about charitable contributions. Taxpayers are allowed to deduct contributions of cash and property to certain charitable organizations. The deduction is limited based on the type of property that is donated and the type of organization that it is donated to. The limits are generally based on a percentage of adjusted gross income, also known as AGI, and they can range from 20% to 100%. Contributions are generally reported as an itemized deduction on Schedule A, and excess contributions can be carried forward for up to 5 years. Many taxpayers no longer itemize due to the higher standard deduction and therefore are not able to take advantage of the charitable contributions deduction. However, beginning in 2020, a special provision in the CARES Act allows taxpayers that do not itemize to take an above-the-line deduction for up to $300 in cash charitable contributions. There's an additional provision in the CARES Act that increases the deduction limit for cash contributions from 60% of AGI to 100%. This increased limit is only for 2020, and in order to qualify, the contributions have to be made in cash in 2020 and paid to a qualified organization. Contributions to donor advised funds and private foundations do not qualify for the increased limit. One tax planning technique that can be implemented to increase your charitable contribution deduction is bunching. This is where you make multiple years' worth of donations in a single year, with the idea being that making one large charitable contribution can increase your itemized deductions. This can be especially effective in years where your income is going to be higher. One potential drawback with bunching is that you will be giving a large donation to your favorite charities one year, and then possibly making no donations for one or more. A donor advised fund is a great way to mitigate this problem. Donor advised fund is like a charitable investment account with the sole purpose of supporting charitable organizations of your choice. When you contribute cash, securities, or other assets to a donor advised fund, you're generally eligible to take an immediate tax deduction, but the funds are then invested and can be used to make grants to charities of your choice in the future. An often overlooked opportunity is donated appreciated property. You can contribute property that has significantly appreciated in value, such as real estate or securities. And if the property qualifies as long-term capital gain property, then you can generally claim a deduction based on the fair market value of the property. And the appreciation in value remains untaxed forever. The IRS has strict rules on documenting charitable contributions, especially contributions of property. And if done incorrectly, the IRS can deny the deduction. So please contact BGBC and we can discuss your charitable giving plan and see how it can be structured to maximize your giving and decrease your taxes at the same time. Thank you.